Today I'd like to talk about the March Chicago Fed National Activity Indicator and update our model of US GDP based on that Chicago Fed National Activity Indicator. The data for the Chicago Fed National Activity Indicator on a monthly basis goes back a long way to the 1980s. And the indicator has 85 individual components, and of those components, in the last month, for March, 50 were positive and 35 were negative. Production-related indicators, they were just slightly above trend, 0.11. Again, what the indicator does, it just gives a rating relative to the trend growth of the economy. At 0 is exactly the economy is growing a trend. So the production indicators are growing slightly higher than trend at 0.11. Sales, orders, and inventories were growing exactly in line with trend at 0.0. And employment was growing just below trend at minus 0.01. And personal consumption was also 0.01, which is pretty much in line with trend. But back in January, there was a individual number below trend. So for the 3-month moving average, the Chicago Fed National Activity Indicator is minus 0.19, or 0.2 of a standard error below long-term trend. Now, when we put that into our model for US GDP, what we're trying to calculate is the year-on-year rate of change. So the quarter just passed over the quarter a year before. And since the first reports on the March quarter were just released in the same month, in the same week as the Chicago Fed National Activity Indicator, they showed that for the year to March, the US economy grew by 2.92%. Now, what's been happening really since the pandemic is that the Chicago Fed National Activity Indicator has been showing a pretty steady growth rate in its GDP estimate, from about 3.8 in 2021 to about 2.6 the year after that, and now it's declined to around about trend. But what's been happening is the actual numbers for GDP have been swinging up and down around about the model as we go forward, and have been getting closer and closer to where the model estimates suggest they should be. So against an actual growth number published by the BEA of 2.92%, a year-on-year growth rate, the model estimated that growth for the quarter to March should be 2.0. But what's great about our indicator is it tells us what growth the US economy should be, not for the quarter that's passed, but the quarter we're in. So it leads by 1 quarter, and it tells us that the year-on-year growth rate for the US economy is 1.991%. And so the US economy settled into a growth rate between 2 and 1.9%. And that's really, really interesting, because at the meeting of the Fed 3 months ago, they suggested that they thought that the growth going forward for the US economy over the next 2 years would be between 2 and 2.1%. And now our model is showing 1.9%, pretty much in line with what Fed was expecting. There is another meeting in the Fed later in the week, and they'll provide more estimates. So we'll be interested to look at that. But at the moment, what seems to be happening is that the Fed is doing a pretty good job. Growth in the US economy has settled down to slightly below trend, which is exactly what they want to do if they want to generate enough space in the US economy to allow inflation to continue to fall. So far, inflation in the US economy has fallen almost in half, down to just below 4%. And we think it'll continue to decline towards the target of 2.5% or 2% as long as the Fed holds a path that it's currently on. So right now, our model suggests the Federal Reserve is doing a pretty good job of generating continuous stable growth in the US economy.